Today we're going to talk about stagflation and how it works and how it can potentially impact your investments. Hey there! So in this video, I'm going to talk about stagflation. What is it? How does it impact our investments? And most importantly, what can we do to protect ourselves from it? Stay tuned and I'll explain everything in detail. In economics, stagflation is a combination of high inflation and high unemployment. It's a situation in which prices are rising while the economy is stagnating or even contracting. Hence the word stagflation. The first half of the word, stag, being an abbreviation of the word stagnating, and the last half of the word flation being an abbreviation of inflation. Today, we're going through what a stagnating economy combined with inflation can mean for our economies and investments, and why famous investors believe we're headed right into it. First, here's a summary of past times we've experienced stagflation and what we did to solve it. Stagflation is a unique economic phenomenon characterized by high inflation and low economic growth. While it is often considered to be a relatively modern phenomenon, stagflation actually dates back to the early days of the United States economy. The most notable example occurred during the American Revolution, when the economy was hit by a combination of high inflation and low growth. In order to solve this problem, the US government turned to Alexander Hamilton, who implemented a series of fiscal and monetary policies designed to jumpstart the economy. These policies included establishing a national bank, issuing debt, and creating tariffs. While these measures were not always popular, they were successful in solving the issue of stagflation and setting the stage for America's economic success. In the 1970s, the United States economy was plagued by rampant stagflation. The combination of high inflation and low growth made it difficult for businesses and households to make ends meet. In order to address this problem, the federal government implemented a series of policies designed to stimulate economic growth. One of the most important was the relaxation of interest rates, which helped to encourage investments and borrowing. The government also cut taxes and increased government spendings on infrastructure projects. These measures helped to jumpstart the economy and bring an end to stagflation. To get down to the nitty-gritty and understand what market forces are contributing to stagflation, we have to go back to the basics. Inflation. Inflation is one of those economic terms that you hear a lot but may not fully understand. But simply, inflation is the rate at which prices for goods and services rise. This can be caused by a number of factors, such as the increase in the cost of raw materials or a decrease in the supply of goods. Whatever the cause, inflation can have a major impact on an economy. When prices start to rise, consumers may cut back on spending, which can lead to a slowdown in economic growth. Additionally, inflation can erode the value of savings and investments, as well as reduce purchasing power. This combination with a stagnating GDP, or overall economic stagnation, will give dark numbers. For example, let's say the growth has completely stagnated and GDP grows by 0% a year. If the inflation is at 8% a year, then the economy will actually shrink by 8% a year. And several economists are predicting that we'll experience negative GDP growth and higher inflation in the coming months and years. So does stagflation come with any opportunities? Stagflation often results in higher unemployment rates and lower living standards. While stagflation can be difficult for businesses and consumers, it can actually be a good time to invest. When the economy is struggling, interest rates are often lowered in an attempt to stimulate growth. However, it seems interest rates are only going up at this point. But the Fed might be forced to go back down on this if we find ourselves in a situation of stagflation. Lower interest rates, however, can create opportunities for investors to earn high returns on their investments. Additionally, businesses may be more willing to negotiate lower prices for goods and services during a period of stagflation. As a result, savvy investors can find some great deals during this time. Of course, investing during a period of stagflation comes with some risks. The economy could take a turn for the worse, leaving investors with losses. However, with careful planning and research, investors can make profitable investments even during periods of stagflation. To be clear, the current state of the economy does not show any indications that we are currently in stagflation. What is 100% certain though is that we have a record high inflation, the likes of which we have not seen since 1982. So how do you weather your investments for inflation? When the economy is booming, investors are often tempted to invest in high-risk ventures in hoping for making a quick profit. However, during periods of inflation, these risky investments often lose value, while more stable options tend to hold their worth. In general, investments that are linked to the real estate market or commodities tend to do well during inflationary periods. This is because these assets usually increase in value as the cost of living goes up. Another option is to invest in government bonds, which tends to maintain their value during periods of inflation. Ultimately, when choosing an investment, it's important to consider how volatile the market is and whether there is potential for long-term growth. By carefully evaluating these factors, you can make decisions that will help you weather the effects of inflation. I hope you learned something today, and if you're interested in finance basics and news, we recommend you subscribe to our channel. And if you liked today's video, we recommend you check out our other videos that are on the top